Hello, this is Luke McCarty with McPherson Financial Group. I'm going to run down a 2022 market perspective as of the middle of May 2022, kind of show you what we're seeing in our economic indicators, what we've done to our portfolios, when we think this could potentially slow down and stop. Are we in a recession? We're going to go over a lot of things like that. So first off is our economic indicators. Currently real personal income's negative. Retail sales is negative. Retail sales is what we're going to talk about here in a little bit when we mention Target, Walmart, your big box stores that are, getting demolished or getting crushed in the markets currently. Housing starts are still positive. The labor force is still positive, and industrial production is still positive. So from this perspective of the economy, things look okay from the economy, but I'll give you a few steps and things that, could happen to where these other ones could go negative, and, we could be recessionary soon, but we'll talk that next. First thing I want to show you here is the Fed. So the Federal Reserve has been raising interest rates. The interest rate now from the Fed is 0.75%. I think if you've listened to any of these videos in the past, the Fed is well behind the curve, more behind the curve than they have ever been. Part of it is them wanting to go slow. The other part is them starting too late. And, the big kicker is, the balance sheet and all the trillions of dollars that have been spent from COVID and stimulus. But this is the Federal Reserve balance sheet. So we're mentioning the raising of interest rates. They are also going to start tapering. So when the Fed tapers, it means they're going to reduce the size of their balance sheet. That has not started yet. That is going to start in June. The balance sheet's about $9 trillion. So you can see here where that dotted vertical line is. The forecast is to reduce the balance sheet. Well, if you reduce the balance sheet, you are selling. So all the assets, all the stimulus back from, November of 2008, there's 2008, 2010, 12, then COVID, you can see the trillions of dollars that's on the balance sheet now. Most of them are treasuries, the mortgage-backed securities. They're going to reduce those by selling in the open market. This has not happened. This is going to create, liquidity constraints within the market. Here's what it looks like. So they're going to start selling $47.5 billion per month. So this is going to cause those further constraints on the markets, and there will be less liquidity and pretty much a guaranteed monthly seller. Back during COVID of 2020, I talked to a lot of clients and I said, we're getting back in the market. You can't fight the Fed. Well, at that time, the Federal Reserve was on our side. Now the Fed is doing the opposite. So if the Fed is raising interest rates, if the Fed is selling securities, they are purposely trying to, reduce spending, reduce consumption, fight inflation essentially. But, the tactics to fight inflation in this scenario could be recessionary. So we do not want to fight the Fed. And that's why we have started selling off in our models, and we are now in cash. Except for the following models, we are cash. So equity income balanced has held up very well this year. The income model is close to going to cash because bonds are down, 10 or 11. I think that model is down around 8% for the year. Our green harvest, which is our tax loss harvesting, those are for taxable accounts. And most of those taxable accounts have a hedge on them. So they are holding up a lot better than the S&P 500. And then the capital wealth planning at Schwab, or by purchasing Devo, the ETF through Fidelity, the covered call strategy. This has held up a lot better than the Dow, and it has about a 6% income stream. So we are still holding that in most accounts. However, we did add the DIVO ETF to some of our models. Well, when our models sold out over the last couple of weeks, we sold out of those unless you had a specific reason or a specific outlier of that position, it is sold. So as of right now, middle of May, right, we are in cash in our models. We don't plan on being there for long term. It feels like with everything happening in the markets with the Fed, with retail, there's a lot of negative that could still happen. And right now we are in preservation mode. Our expectations. So, when the markets begin to normalize, we will dollar cost average back into the markets. We are not making the assumption we're going to time the bottom of the market and go all back in. That is very difficult to do, but we are going to dollar cost average more than likely, from a 25%, right? When we start seeing the bottom, when Art and I see the bottom, or when the indicators are telling us, hey, we're making a bottom in the market, that's when we may take your portfolio and buy in 25%. And then if it goes up from there, kind of keep buying and dollar cost averaging into the markets. So we need inflation to be significantly lower and on the downtrend. Earlier this month, inflation went from 8.5% to 8.3%. Well, before, during that time frame, gas is now all-time highs. We've had retail show a lot of concern and miss their earnings essentially because of oil, because of the price of goods, because of the price of shipments and freight. And so, if you're the CEO or you're a Walmart owner or a Target owner, or I'm saying owner like big time owner of the stock, and you're in charge, the next step for you not to have that happen again is to raise your prices. So we feel that with the price of diesel over $6 a gallon, inflation is going to stick around for longer than the expectations initially. And, we will begin adding in some buffered and hedged positions back into the portfolios. At that time, we're not just going to go all into tech or, individual stocks. We're going to dollar cost average at that time and potentially use some tools and some types of investments that have some downside protection as well. Some alternatives in Fidelity. So now that we are cash in most of our models, some of our accounts have these in them. Some do not. So we need to, look at your portfolio, and that's something we're going to do in the coming weeks, and potentially buy some preferred stocks for you. So in this preferred stock world, right, we're averaging around 5.5 to 6% of dividend with no fluctuation. So you can buy a preferred stock on, say, Bank of America, get a 4 or 5% dividend, but it fluctuates with the market. So we are buying companies that do not fluctuate. So you have no principal fluctuation and you receive your dividend. One of the ones we've been using currently is Prospect Capital. It is a middle market bank. They had really strong earnings this month. It pays between 5.5 to 5.9%. You can have it to where it's liquid twice a month. You can have, where you hold it for 5 years, and that determines your break even, 0 to 6 month kind of break even on that if you want out. The new one we're introducing is Gladstone Land. This is farmland. Think of pistachios, berries, crops that are replanted, not necessarily your commodity crops like corn, wheat, and soybeans. So this dividend here is about 6.38%, and the hold on this is about 3 to 4 years, but there's an 8-month break even. So if you hold it for at least 8 months, you're going to break even, assuming that dividend is currently paid. The risk on these and any given stock, and even the preferred, is just company risk, because it is a single company holding. So, our thoughts are, in a 3 to 5% range to buy these into your accounts. These work really well as bond alternatives. So any account that was moderate 65, balanced 50, conservative 30, even our income, anything besides the stock model and max growth, these are really good positions that we're going to start adding in currently to continue the income stream within those accounts. Another option that is more of a true alternative is a floating rate income fund. It is positive on the year so far, and it has about a 10% dividend. So this is 2,300 senior secured loans, and they are floating. So the floating means, think of it like an adjustable rate mortgage, except you own the mortgage, right? It's not mortgages, but you own the loans of these companies. As interest rates go up, the interest rate on the loan goes up. So that's why it's been positive so far this year with such a good dividend. So these are some alternatives in Fidelity we're going to start looking at for you and your accounts. The preferred stocks are easily purchased through Fidelity. The floating rate income fund is more of a subscription agreement because it's not liquid. It's only liquid on a quarterly basis. So we'll be very careful and cautious on what we're doing here, and we'll be reaching out to you on these alternatives outside Fidelity. So we use fixed indexed annuities. As rates are going up with the Fed, the rates and the performance in these fixed index annuities are going up because now you have a higher participation rate in the index. Fixed annuities. Right now you can get around a 3-year fixed annuity for around 3%. A lot better than a CD rate right now. Indexed variable annuities. This is where you can get a 20% downside buffer on the S&P 500. So if you bought one of these today, you're covered on the next 20% down on the S&P, but you participate in the upside. So, these all have some sort of time frame involved because they're through an insurance company, but these are some good alternatives outside of Fidelity if you don't need the liquidity and if we're trying to, buy into the market with a lot less risk. Another option is an I bond. The U.S. Treasury, right, is now offering I bonds at 9.64%. The catch is you have to log into their website. You have to purchase it on your own, and you can only do 10,000 per year based on Social Security. I've mentioned these before. It's a great place to put some cash. They are illiquid for the first year, meaning you need to keep it in there for at least a year. That 9.64% fluctuates every 6 months. But these are some good alternatives outside of Fidelity, outside of your traditional stock market. When we look at a recession, right, what are we thinking? I mentioned the $9 trillion balance sheet of the Fed that they are going to start reducing in June. This is going to cause further constraints on the market with less liquidity. If we're looking at recessions historically, the first stage is the stock market, right? The stock market down 20% is considered a bear market. We're there. Right. The second stage, if there is a second stage, is corporate earnings. We've started to see that. Walmart, right, was down 14% on bad earnings. Target was down 25% on bad earnings. There's been a lot of big names that are historically on the value or less growth side of the stock market that have been getting hit. And this is just recently as of this week. So potentially we could be in the second stage. And if you think if corporate earnings are going down, the third stage would be unemployment. So we are not there yet. Unemployment numbers are still really strong, still historically low, but these are the stages, right? The stock market first. And then if corporate earnings go, then unemployment follows. We're not saying that's happening, but it looks like, at least from, this current week with Walmart and Target reporting, it looks like the retail side of, the market is showing weaker earnings. All right, we're going to be looking for opportunities to buy back into the market. I mentioned a lot of different alternatives we can use in your portfolios. Once again, this is Luke McCarty. Send me an email, call the office. We're going to be reaching out and looking at your portfolios and seeing some different positions we can use on the safer side with cash. And there's some of our disclosures. Thanks, guys. I'll talk to you soon. Bye.